let's go to my panelists. I think we're going to take this panel in three different ways. The first way we're going to talk about is, Annie's going to talk about valuation, and maybe you want to bring that into where we stand in the private markets versus the public markets, and these large, remarkable ventures that have risen up in, what would you say, the past 5 years or something, from nothing, that now really have extraordinary valuations. But then I'm going to push them to answer just really 2 or 3 questions, which is, what is emerging, what is disruptive that we don't know about sitting in this room? Where, if we have this conference in a year, are what companies might we be talking about, or what industries are they in? Secondly, the opposite. What do you think maybe is getting a lot of heat now, but maybe it's kind of undeserved? And thirdly, and this is the toughest thing to ask investors, if we had this last year and we could recall what was being said, we did have it last year, where was the great optimism, and where did that optimism both fail, and also where was the non-optimism that all of a sudden manifested itself in things that were promising? How has the landscape changed? And I think if we do that, it would be a terrific panel. And with that, I think I can turn everything over to my panelists. So let me begin with you, Annie.
All right, thanks, Tom. So just to put the sort of market valuations in context and think about the market environment right now, I think about it over the last 20 years, and there's really been kind of 3 manias, and they're very, very different. So if you look at the early 90s, you had this perfect arbitrage where you didn't have that much venture capital out there, limited dollars. There was more control on the finance side than with the entrepreneurs, and valuations were very cheap in the private market. But you ended up having a little public bubble. So there was just this perfect arbitrage between cheap private deals and being able to take them public at high valuations.
This is the 1990s.
This is early 1990s. And then late 1990s, 98, 99, 2000, we had a crash. What was fascinating about that was it all happened sort of simultaneously. You had very high private valuations. You had very high public valuations. And the public valuations were, in the billions. They were high enough so that people were getting extraordinary returns in a very short period of time. Then, as we all know, it ended very badly. And anybody who raised money in 99, was putting money to work in 2000. It was not a good thing as a venture capitalist. Industry, took years to recover. But, sort of fast forward to those, kind of bubbles, to this mania. And the fascinating thing is that you have very high private valuations, and you do not have irrational exuberance in public IPOs. And so it's really this fascinating thing where I do feel like 10 years later, really 17 years later, you have many more great companies and opportunities with mobile data, cloud, just disruption happening everywhere, which makes people, excited about the companies that, they're investing in the private market. But you kind of have this broken public market, and you don't have, maybe it's too rational, because there is no irrational exuberance, and it's very hard to get a company public. And we can, talk a little bit about it, but if you actually look at the last 5 years, the last private valuations of those companies that went public are on average the same. There is no uptick from the last private round to the public round. And actually, if you look at companies in fintech that are being sold, which is generally in the 200 to 600 range, about 80% of all liquidity events happen in that range, and companies that are sold, then there actually is this sort of nice, sort of progression, logarithmic progression to value.
So your benchmark for high and low is the transition value. And what you're saying is that there is not really a transition discrepancy. You might as well be private as public. They're equal markets. So let me just ask you about this, because you said that they're high in the private market and low in the public. But in fact, well, I guess that just argues that a lot of people stay private, right? This is
the problem, right? You can't, how do you go public? It's very challenging, right?
Besides for that transition event, is there any other way to measure that you have high valuations in private versus public? Given that earnings aren't really a good benchmark for a lot of venture factors and price to book or any of those
One thing I would say, and I'll let Ryan talk about, but is that 80% of exits in fintech versus technology, healthcare and fintech are actually very similar. 80% are actually to strategics, and they're under 600 million in value. So this sort of obsession with unicorns. The reality is most companies are going to be exited at under $600 million. So you have to be thinking about when you're looking at companies and thinking about value. I mean, your exits are mostly going to be strategics, not the public market.
So we're definitely seeing a situation of less unicorns and more unicorns, like close to the billion. And it's because of the strategic acquisition. But what I've also found is that whilst you can apply the science of investing and the science of valuation in the public environment, because the metrics are there and the comps are there, it's a lot more of an art and maybe even more psychology investing in the earlier stages. One of the biggest discussions that we have with entrepreneurs at the time we're ready for investment is this question, or rather fear of dilution. You have entrepreneurs coming in saying, well, I'm only looking to sell 20% of my company. Well, if you're looking to sell 20% of your company and you're raising $5 million, that implies a valuation. And in an environment where there's a huge amount of cash chasing deals, particularly from angel funds or independent investors, a lot of corporate venture firms are starting up, what do? You have to apply it and focus on the psychology. And in that regard, venture capital is more human capital and human relationships than the true art of finding real valuations at an earlier stage. Things do get harder and more firm later on, particularly when you hit that exit path of between 200 and 600. And certainly companies I'm involved in are facing with that right now. That comment earlier, though, about real valuations in the public markets versus where we are is probably best borne out by a company like Square that went public in November 2015 at an offering price that was lower than the prior round of private financing. Today, the company is higher. It probably doubled over the past year. It's a market cap of about $10 to $10.5 billion. And some out there opine that should be worth $15 billion or $30 billion if there's an ultimate exit. Jack's not selling. It's going to be a 5,000-year company, so let's see what happens in 5,000 years. But it's really interesting to see that if there's solid execution and a real focus on your customers, you can start seeing rapid appreciation in public markets once you do go public.
Well, this is really an interesting point, though, that you've made, that then the key investors, from your point, are no longer individuals, they're no longer funds, they're actually corporations that are just buying these things at $600 to $800 million at a clip. Are there certain, now you specialize in healthcare and fintech, and you in
Fintech.
Are there certain very, very big I mean, I've never, we talk about investors being like, I don't know, Warren Buffett is an investor, or someone in the Barron's Roundtable is an investor. But now what we're really saying is the biggest investor might be someone who works in a bank or works in a large healthcare company. Are there major investors now that you see that we wouldn't be aware of? They could be, I look at Square, Chase is a major investor in Square, but it hasn't fully acquired it, so it's an outside investor. But are there financial institutions or healthcare institutions that are scooping up a lot of these healthcare and fintech things that we're not aware of?
First Data Corp, Cap One, any of the banks, insurance companies.
It's not any of the banks, right? It's some of the banks, right?
The larger banks.
First Data, Capital One. This is, I cover finance. I didn't realize that this was going on in
I'll
that
send
way.
you my list, Tom.
But if you wanted to, if you're a venture person and you're interested in your exit, it used to be you would go to an investment bank, and you would have them shop your thing or take your thing. If now you're saying that the strategic buyer is really the key buyer, then there are going to be a limited number of strategic buyers that you are actually pitching your deals to. And so
I'd say the pitching is best done through investment banks.
But it's to a limited number of strategics,
Absolutely.
Right.
So Capital One, that's interesting. First Data, very, very interesting.
PayPal, Square, Lending Club, Wells Fargo Bank.
They're all
The Third
acquiring
Bank.
things.
Absolutely.
Experian,
Yeah.
Equifax,
They're large acquirers.
TSYS.
So a lot of these acquisitions, if they're 200 to 600, may not be considered material, so they may not appear on their financial statements in the list of stuff, so we would miss them. But I guess that when you see a company reach a certain stage, because you're on the boards of many of these startup companies too, you start gauging the interest of these other buyers that are involved. That would be part.
Yeah, it's part of the value, focusing on fintech is that you know them. I'm on text with CEOs of most of these companies. You know them, they know you. You know them as helping your company sell to them as customers. You know when they're interested in terms of properties they want to sell. They literally call us directly and say, when you're ready to sell this company, we're interested. So that's the value of being, the keiretsu, being part of the ecosystem.
So, this is terrible for the public reporting of these things because we get, and I'm not saying that's a bad thing, but if you look at how the press operates, we get prospectuses under the 33 Act, and it's the 33 Act that gives us our first look. And, I don't know how many of you, maybe many of you in this room have actually read prospectuses. A lot of you don't, but the prospectus, even if you don't read it, becomes the primary source document that then manifests itself in all those news stories that you see. And from what you're saying, there's no prospectus that's ever going to be issued on any of these companies because the sale will take place before that, and the buyer won't be. In healthcare, who are the major purchasers of these things?
It'd be Anthem, United Optum, mostly health plans. I mean, hospital providers don't buy things. So if you think about who are the customers, so it's mostly the insurance companies.
Mostly the health insurers.
Yeah, mostly
Part
the
of
health
them,
insurers. They have scale too. You in order to buy $500 million, something worth $500 million or $1 billion, you got to have real scale to take a risk to do that.
And their margins are consistently under attack.
Yeah.
You've got a lot of doubt from a regulatory perspective, so perhaps technology is a way to improve their businesses and provide better customer service across the board.
It seems like a very clever way. It's just I don't even know if you do a $200 million acquisition if you have to issue a press release. I don't. It's probably that. No, you don't.
No.
Probably don't, but you probably will.
So this is an entire world
won't
of
see it
acquisition and venture capital investing that will never see the light of day, and yet maybe some of your most promising companies are involved. And then when the owners sell, let me you were saying they only want they don't want dilution, but when they sell to these larger companies at $600 million, are they generally out? Is it a full sale with their technology and they leave, or do they stay within the?
Usually, they're usually out, but it's usually a 1 year or 2 year period. And we did a transaction recently with FDC, and there was actually a 3 year relatively FDC, First Data Corp.
First Data Corp.
Where there was a 3 year period of a very large payment to the management team in order to stay and be part of it.
One of the most important discussions or negotiations in these transactions is the future of the management team. What's the role going to be? Because entrepreneurs who feel they're disruptors want to disrupt. Well, the last thing that's going to happen is a billion-dollar company buys you and you break it up from the inside. No.
Now, I think you once mentioned to me a couple of years ago that you've worked with these entrepreneurs in subsequent ventures and stuff too. Is this true?
Oh, it's the 40% of what we do is repeat entrepreneurs. So I've backed people 4 and 5 times over the last 30 years.
So the model now, so for 80% of your companies, you're selling them at a fairly small size, then you're taking the management teams, they transport the technology, I guess it's that sort of thing, and then you create a new company around them. You guys are all locked out of all this stuff. Wait a second, there's a question over here.
Yeah.
You.
Unless you invest with my panelists.
Thanks. Can each of the panelists comment on the global environment? You've spoken mostly about just U.S. fintechs and U.S. banks, but I'd like to get kind of broader context.
Sure, I'll be happy to do that. I think the global environment is as exciting as what we're seeing in these 50 states. $17.2 billion were invested in fintech companies in 2016. We're going to probably beat that number in 2017. A lot of that is driven by the work of companies like Alibaba that are significantly investing in companies in countries that most Americans have never visited. I'm on the board of a company in Bangladesh based in Dhaka, and that company is approaching a significant valuation just focusing on money transfer in Bangladesh, a company called Bcash. And it just shows us that, I'm in San Francisco and he's here on the East Coast. We see things within our 50-mile radius, but the world in fintech is pretty flat. So we're excited about what that means. Internationally, of course, you don't have to deal with Chairman Levitt and people like him. You're dealing with other Chairman Levitts. Every country has a Chairman Levitt. But what they all need...
Which is probably more concerning in China than here.
Absolutely.
So,
But what all these countries do need are great technologies that are going to change the way their businesses run. One area we're pretty fascinated in is AI and machine learning and natural language processing, particularly from a customer service perspective. And we've invested in a company called Casisto, based here in New York, that's helping in a big way fewer digital banks change the way they serve their customers, where 82% of interactions in these emerging markets happens through the bot. That's big. So we're going to see more and more of that happen.
So let me just continue your question. If we were really diligent investors, individuals, or reporters, is there a part of the world that we would be looking at and saying that's really, really an exciting place for us to focus our attention? There's a lot of stuff coming out of there, besides Bangladesh, which has a money transfer. Yeah.
Well, Ant Financial, I think, is one of the most interesting companies out there right now. So
you can explain what Alibaba's doing, but
Alibaba's payment side. So I think they have vast corporate power, global power, and I would say it has to be China. in terms of focus. Just see what they've done with, I don't know if you've followed what they're doing, with Bitcoin and ICOs. I mean, they've shut them down, these initial coin offerings. They've shut them down, but it's not to shut them down, it's to have the state control them. So eventually, this will be their own fiat currency. The Bitcoin will be a Chinese fiat currency when it comes back out, right? They will probably allow ICOs, but there'll be some, guardrails
You had a
around it.
fantastic statistic about these coin offerings or these surrogate coin.
Oh, well, it was, there was $1.9 billion raised for fintech companies in the last 6 months. And that's more than has actually been raised for other, traditionally for Bitcoin companies. So meaning through venture capitalists or public markets.
So let's just get this straight. Of the money that was raised for fintech, a huge percent was for these coin related.
A huge percent was through these initial coin offerings, which is.
And Tom, I don't think that would add into the typical VC component of that 17 billion I cited. A lot of this money going in these coin offerings is being recycled from folks who have made billions of dollars on Bitcoin and Ethereum and Litecoin. Billions have been earned or won.
Value created, yeah, exactly.
The past couple of months
Value.
as these currencies have gone up and recycling is happening in the dock.
My name is Sahil Kinney. I run a small venture fund in Bangalore in India. And in that part of the world, we're seeing a lot of activity from Japanese strategic. So SoftBank's $100 billion fund is laser focused on India and China. To take your point forward around Alibaba and Ant Financial, these companies, the big three in China, put out about $30 billion of cash every year. And they're actually taking over, the largest companies in India all have Chinese money in them. And these are all unicorns. I don't know if they're ever going to go public because they're always going to have cash coming into them. So I don't know how you look at these companies from a value creation perspective. Are they just going to acquire them, or do you see these companies actually going public at respectable valuations?
Do you want to take that?
Yeah, so it's not easy. I'm giving your point of view. I would say, look, I'm sure every situation is going to be different, but I do think that it probably will be a strategic acquisition for most of them. I mean, I think you'd probably know more about the environment there in terms of the public environment, but I think it's been so volatile that most entrepreneurs don't feel that they're actually cashing out, when they're going public. And this is the problem. It's a problem in the U.S. It's a problem, across the world. Is it's not a liquidity event, and it's very hard for an entrepreneur to actually cash. So you've got to have either the 5,000-year perspective, or and the reality is you need to be sticking with your company and believing that it's what you want to do for the long term. And as I've said, a lot of people want to be serial entrepreneurs. It's not that one idea. I would say 5%, 2% of entrepreneurs, it's their one idea. They're going to run that company, for the next 25 years.
I'd say also there are so much, you speak about all these lasers, it's amazing that you're not all blind. And the challenge that these entrepreneurs should try and figure out is what kind of investors are they getting? They can raise a lot of money at crazy valuations, but are they actually going to get venture investors who are going to come in, roll up sleeves, and make these companies successful? Otherwise, it's a quasi-acquisition of a minority stake, and you're going to get a boss, you're not going to get a board. Right. That's when things start breaking down, and you're seeing it with a number of those companies in the retail space right now. So, big money at big valuations doesn't mean future success. It means you're getting over your skis, and you're going to fall down.
Two questions, if I may. The first, Vanessa from Citi mentioned that sometimes a startup is in an environment where there's no ecosystem, so it's challenging. But sometimes they're in an environment where there's a fundamentally threatening ecosystem that's actually trying to hurt them. So questions about navigating that. And the second just relates to women. And I had heard a statistic that maybe 1% to 2% of venture capital goes to women-owned firms. So how's that going?
How's that going? Not well. Better.
So let's separate those questions
yes,
into two. Women.
Two different questions. Oh, you want to start with women?
Yeah.
Okay.
It's just the most common.
So, it's kind of interesting. So if you look at the venture industry again, sort of in the 90s, early 2000s, there were a number of Indian entrepreneurs and a number of Indian venture capitalists. It was kind of this thing that went together. It was very interesting in terms of, sort of feeding the environment. There were a lot of telecom entrepreneurs who were Indians. And it, it really sort of changed the venture world, and it sort of changed the dynamic in terms of entrepreneurs and who got funded. And I feel like in the first time in 30 years I've been in the business that there are many more women who are trying to be entrepreneurs. They're in the game. They're out there with business plan. There's the confidence behind it. There's the larger ideas behind it, because I think women, if you look at, most small businesses in America are supposedly started by women, but they're small businesses and they remain small businesses. So, coming with, the balls to actually say large ideas, put myself out there. I'm beginning to see it with 20 and 30-year-olds, and I love it. So I actually think it's going to change in the next, 30 years. 4% of, VCs in partners and principals are women right now. It's ridiculous. It's a really great profession for women. I think we're good at it. And so I think that will come, together, where there will be more VCs, there will be more entrepreneurs, and we will have more great companies because of that.
Did you want to say anything?
Yeah, I come from a country that had labels applied to everyone for so long until 1994. And in 1994 in South Africa, things changed a hell of a lot. And having lived in the United States for the past 20 years, I think we're so backward in this country and continue to recede that until somebody or some groups put a brake on that, we're not going to go forward. I look forward to the day when we stop applying labels to individuals and really ask who is the best for this job. The challenge that we have in venture and in tech generally is the education basis. This whole thinking that it's going to be for little boys and not for little girls. I'm going to predict in 20 years' time, one of the top VCs will be my daughter, because she's interested in this. And when she watches the Shark Tank and sees some of these silly products that they're putting on there, for example, mirrors that make you look thin as opposed to show you who you are, and they try and sell them into retail, she says, Dad, I want to invest in a company like that.
Yeah.
Those are the type of people we need in venture, and folks that will work very, very well. So I'm excited about it. I also think this concept of what's an entrepreneur and what's a VC is going to change so much. You don't have to be in New York and San Francisco. You can be wherever there's going to be innovation, wherever there's excitement.
Thank you for the panel. York Rose from Microsoft, and I actually work on our blockchain area. So you sort of skated across the ICO or token launch question, which I think if we dig into what the characteristics of that are, to your point, there's a lot of new money coming from a new source, right? And it's sort of a global phenomenon, right, in terms of where the money's coming from. So it's not geographically based anymore. And these are companies that, because of their valuations and the way they've created token utility and value in these tokens, they're not going to go public, right? And in a lot of cases, they may never be acquired by anyone because they can be self-sustainable based on the type of economics that they've created. So how does that sort of impact your market, and how do you think about that?
Should I take it?
Go ahead.
I think it's
I'll
wonderfully
pick it up.
exciting. I said a couple of months ago, after those first ICOs in May and June, that we're seeing something that we've never seen before, and quite frankly, none of us really know how to deal with it. It's changing venture capital, particularly for VCs that are equity investors in these earlier stage companies, and these companies are never going to raise another round of equity financing because the ICO is going to fund operations, and they're actually selling something. And that's huge. It's changing VC because of instead of simple agreements for future equity, those safe agreements, as many in early stage are doing, you're now seeing something called a SAFT, a simple agreement for future tokens. Unfortunately, nothing is simple. It's more complex across the board, so that S has to be dropped. But the reality is not every company should be raising venture capital, and not every project should be having a token offering. And we're going to really see it being figured out across the board.
I would like to go back to the point raised that now 80% of startups successful startup end up being strategic acquisition, not IPOs. 20 years ago was the other way around. Now, what has changed in the marketplace? Now, the obvious answer is now strategic buyers are willing to pay more. But the question is why? The answer is synergies, but as an academic, I know only two types of synergy. One is cost cutting, the other is market power. Since I don't think it's sort of cost cutting, is it really a sign that the market is becoming more concentrated and market power is very important?
Before you do, is that Mr.
Yeah.
Zingales?
Yes.
Out there? I love your book. So yeah, I love both of your books. So that's Luigi Zingales from the University of Chicago. Anyway, so you guys, yeah.
I think it has, it's less that strategics are willing to pay more. It has much more to do with a fundamental change in the public market in the last 17 years. I actually started my career at Hambrecht and Quist, which was considered one of the four horsemen, which was boutique investment banks that did $30 million. I carried Steve Jobs' bag on the Apple IPO roadshow. I was there for the Genentech IPO. But we did a lot of $30 million, $40 million IPOs. And there was a whole set of buyers that was interested in that. And it was like advanced venture. It was, these companies were small, they had broken through, at some level, but it was, it was still risk capital. I think a couple things happened after 2000 and the crash, and we put all these regulations around it, so you sort of scared those investors away. There's also been sort of a massive aggregation of capital, though, and a different view on how you make money. And that was, right now, people, my friends who invest in the public market, they're not interested really in anything under $1 billion. 500 million is sort of, in terms of market cap, like the minimum, because they say you can't really make money. Because if they spend time investing in those companies, they really need to be able to put larger dollars to work in larger cap companies. And they're not, other than the biotech market, which is an exception to this, and is doing these small IPOs, nobody else is really aggregated to focus on that market. And there's too much risk for the board to take most of those companies public, because of all, the, frankly, rules and regs around it, and lawsuits around it. Nobody really wants to be a public company with all the infrastructure around that, even with the Jobs Act,
Which is
at that size.
This is such an important topic. I wish we could have 20. Thank you for raising that question. We're going to end, but do you want to say something quickly about that too?
No, I just want to say, why go public? Give me a great, one simple reason why any company should go public today. And I don't think Chairman Levitt could give us one. So,
all right. So that's a very powerful answer, and this panel raises a lot of really important questions for the structure of American capitalism, and I'm so sorry that it has to end. But anyway, I guess your need for coffee is greater than whatever. So, hopefully this was caffeinated by itself. But thank you very much for attending.